Hello, hello, hello. Welcome, everyone, to the Wednesday afternoon closing playbook. I have some good news for you. We have two normally here people that are actually going to be here. There's probably a better way to say that, but Nathan and Graham are back. They will be with us in just a couple of minutes. But in the meantime, let me get into just a couple of things that you may have seen already and probably don't know yet. For those that are brand new to Closing Playbook, welcome to your first one. This is a free daily webinar that provides a fast paced end of day trading session with some additional content, including daily recaps, planning the next day, some trading concept, education, and occasionally a special guest like we are also going to have today. We normally focus a bit on live trading more in the closing playbook than we do in the opening playbook. It's a little more fast paced because we only have a half hour to get trades in, and we normally try and get as much of that done as we can. And we are going to look at NVIDIA today. And then after that, we will get into some education and some brand new concepts in trading, different from what we have normally with Nathan and Graham. If you're new to the platform, when you come to the page where you join the meeting, don't click on that login here link. If you see it, we're getting rid of that. It might still be there for some of you. You just need to put your display name in and click join, and you'll be in. Again, if you're new to the platform, a little bit on how to kind of manipulate the interface a little bit. If you click on the hamburger menu at the top of the screen, the three horizontal bars, that'll shrink the left side, the green column on the left, and that will give you a little more screen real estate for the screen share. And then there's a mute button that looks like a speaker in the bottom left of the video when you either hover over it or tap on it, depending upon your device, that you can use to mute or unmute the audio. So if you can't hear us at all at any point, if you lose sound, double check, make sure you didn't accidentally click the mute button. And then if you still have trouble, just refresh and you should get your audio back. On the bottom right of the video, there's a double arrow icon that'll make the video full screen. And there's a little box in a box icon that you can use to make it picture in a picture. So if you're on a device that only has one screen and you want to flip to your brokerage account or something else while the presentation is going on, you can try using that picture in a picture, and it'll allow you to kind of do two things at once. But it is device and browser dependent, so not everybody has that icon showing up. We recommend using the Chrome browser because it gives people the most option on the picture in a picture. Below the video, there's a little slider called low latency. That causes, when it's yellow, it's on, and that gives you the fastest display, but it can be a little touchy with the quality. So we recommend that everybody turn the low latency feature off. That'll cause just a few seconds delay between when we say and do something on the screen and when you hear it, but that'll allow you to have the best quality picture and audio, and a few seconds is not going to make a difference. And lastly, when any of the hosts post a message inside of the chat, you can hover over the chat and you can click on the double speech bubble icon, and that will let you private message me, Graham, or Nathan. Send us a question you might not want everybody else to see, or a comment or a suggestion. Give us any personal information that you might need to give us, like your email and your phone, without it being in the general chat. Coming up today, as I said, Nathan and Graham are back from their day and a half of company meetings, but we also will have a guest presenter. Kane Shee will be here. He's going to teach us about a different kind of spread than we normally get from Nathan and Graham. And he's going to explain how decay acts differently on options with different expiration dates, show us how we can get into these trades and out of them automatically, and all kinds of really cool stuff coming from Kane. So we're going to start out first with Nathan and Graham. They should be here any minute now, and we will get started in just about a minute. Let me see what we have going on in the chat. All right, just a bunch of hellos and no real questions, so that's cool. Hello, Buck. Hello, Karen. Hello, Pete. Hello, James, Luigi, Patrick, Nathan, Joanne, the Flying Ronin. That sounds dangerous but cool. Patrick again, John. Hey everybody. Steven, Sherry. Cool, cool, cool. David F from Florida, David B from maybe Florida, maybe not. We don't know. Hello from Germany. Flew in this afternoon. Hello, Luann. Yeah, we have actually a portion of our company in Germany, and we have a lot of people traveling back and forth from Bonn, Germany, and other areas. So, and of course, really the most important thing to know about Germany is not about any of its people or its history or its beautiful scenery or buildings. It's not about its wonderful meats and breads. It's not really about its beer pubs. The number one thing, in my opinion, to know about Germany is that it is where Haribo gummy bears come from. That is the most important thing you need to know about Germany. But they don't teach that in all the history books. I've gone to a few different schools and they never taught us that Haribo comes from Germany. But you need to know these things. Very important. Hello from the Philippines. Hey, Chris. Oh, hey there, Graham.
Oh, hey, man, what a couple of days it's been. We've obviously been out with our annual meetings. A lot of really cool developments to share with you guys.
Nice.
Along the way, I gave a little sneak peek in Telegram of already what we've been able to do with the Apex indicator. It's going to blow you guys away. It's blown me away, and it's only been 2 days working with the developers on it. So really, really excited for what's to come. I do apologize that we missed we weren't able to get on the opening playbook, last 2 days closing playbook yesterday. But hey, once a year, I think it's worth it when we can come out with this side of it with that much groundwork done.
Well, you better have something really good for them today. They were mad.
Oh, I'm sure
they were mad.
Let me just show you guys a little sneak peek. Just curious, who here has the Apex indicator? Today's not about the Apex indicator. I just want to show you just a sneak peek.
John does, Rich does, Warren does, Scott does.
Check this out, guys. Check this out. So it's not all. There's still some kinks here, guys. But basically, if you can, let me on my screen to. All right, we're gonna go to the vortex here. We're in the vortex. All right, check this out. So if you're familiar with the Apex, you probably know what you're looking at for the most part, right? Here's all of our tickers that we're trading. It tells us which ones have active signals. Obviously, if it doesn't show that, they don't have an active signal. It will also light up green and say new signal if there's one that's just fresh this week. So here's, Apple, current price, target price, stop loss, like you guys are used to seeing, the chart like you're used to seeing. But like, check this out. So let's just go take a look. I was just playing with Meta. Let's get, please work for me. Please don't break on me. Again, this is very early development here.
Yeah. This is alpha version, folks. This is alpha version.
We're not
even at beta yet.
Obviously, this chart will look prettier for you guys. It's not done yet, but you can see all the previous signals, the current signals, current price, stop loss. Check this out. I'll get to this next. But look at this at the bottom. You can back test it yourself. You can set the date range. We're going to get as much data as we can in here, so you can get all of the information you need. So like, let's just see. I don't know what this is going to pull up, but let's see if this works. Again, this is not on a live site just yet, but we'll see if these numbers update. If they don't, they will in the future. So it's running for me. Again, this is on my own. Okay, there you go. So last 2 years, 100% win rate, average return, average hold time. Look at this. It shows you the trade history. So that's cool, but that's not even the coolest part. Coolest part is the logic is now programmed into here based off of the full data set for each stock individually, has their own information. We can come here and click call option trade, wrap ordered, max ROI spread, which should basically be a spread at the target price timed up with the average hold time. So let's see if this works. Wrap order, clicked it. It takes a second here. It'll be quicker once it's live.
Yeah, but it's also doing a lot of work. It's doing a lot of work.
So let's see here. Wrap order analysis. This will look prettier too, but you can check this out. Buy strike, sell strike. It gives you well, it went away, but it should give you just basic information. Expiration dates, the strikes. It'll do a calculation at the bottom as well. Obviously, you can trade different ways, but huge upgrade coming here for Apex members. But just wanted to give you a sneak peek at what we've been working on.
Very
over
cool. Very
the
cool.
last 2 days. So yes, we did unfortunately miss opening playbook, closing playbook, but you guys are going to see a lot of cool things, cool upgrades coming your way over the next year.
Awesome. All right. Well, let's see. Yeah, Gwen, it will be, you will access it through the one-click portal. Yep. Once it's out. It's not out, but once it comes out, yeah. Yep.
Brandon, yes, pretty much like that. And we have questions about Newton, guys. We're going to see a lot of new developments across many different programs and things that Nate and I produce, including some really cool future ones as well. So for you folks who did the HQ on Nate, you're going to be very pleased here this time next year when you see all the value you picked up along the way.
Yeah, those who aren't familiar with Apex, we're going to be doing some demonstrations on Apex coming up. As soon as this tool is added, we're going to be doing some definite demonstrations on that. If you want to get kind of an early sneak preview of it, are you cool with me giving out the last replay of Apex, Graham? Or you want?
Oh yeah. Actually, let's hold off because we're going to do a big special thing when we have this whole thing running. It will you still will be able to access it in TradingView. You can still download the indicator on Thinkorswim, but I'm trying to make it even better where not only do you get the indicator, the signals. Right now, you get the indicator, you get the signals, which is great. It's a great start, and you have a little scorecard cheat sheet.
And it's going to run independent. It's going to run independent of platform, right? Like anybody can just view it in their browser
from your phone. You can be sitting by the pool on your phone, pulled up. And the big upgrade outside of the back tester, I'm going to try and add in an optimizer so it can optimize itself as time goes on. But the big feature is going to be that it's going to give you some option selection as well. So yes, you'll still have it for Thinkorswim. You'll still have it for TradingView if you want it. But this thing is going to kind of be the central hub for Apex.
Awesome. All right. Well, we're like 7 minutes in here. Do you want to get into NVIDIA or?
Yeah, let's throw Kane up here. Right. We know we got Kane joining us today, and I know Nate's supposed to be getting on here too. I ditched a meeting early just now to join you guys. Hey, Kane.
Hey, how's it going?
Good. How are you doing? And Kane,
I'm great.
I sent you a link in Slack if you need to pull up this.
Yeah, I saw that. Thank you.
Yeah. Okay, cool. Awesome. Well, I'm kind of playing a little bit of catch up here on the stock market because, again, I've been busy like a bee the last 48 hours. But let me go ahead and share my screen. Oh, hey, Nate.
Hey, gents. How are you guys?
How's it going?
Let's take a look how things are cooking right now.
Well, just as blindsided by the market as Graham. I've been in wall-to-wall meetings for 2 days and trying to figure out what all is going on here, but obviously don't have to look real hard for the big story of today.
They didn't get the memo that you guys were going to be in meetings and they should pause the market.
Yeah,
they did get the memo. The market has paused. It's barely moved in the last few days.
Anyways, all right, well, let's take a look here. It looks like Apple is making a nice little move higher. Did you guys see the announcement? Was it yesterday about the AI event coming up?
Yeah.
We'll see if it's smoke and mirrors. I'm sure hoping not, but we'll see. Kane, obviously we have NVIDIA earnings today. We have Snowflake. We have a couple other ones. Let me just pull up my FinViz. Snowflake. Who are some other big ones today? Oh, CrowdStrike is today.
CrowdStrike. Yeah.
Yeah. And then obviously tomorrow before they open, let me just look. Not very huge names tomorrow. Best Buy.
Yeah. There's a smattering of retail and some healthcare that are pretty large, but you got all the tech names, I think.
Yeah.
All the major tech names.
Has NVIDIA beat its implied move in the last 5 or 6 earnings?
Well, this one it definitely did not.
I mean,
well, maybe by end of day, but overnight, I'm not seeing it there. I mean, again, I'm guessing the implied move was more than $3 or.
I think the implied move has been, as high as 10% 2 years ago, but now normally in the 6, 7, 8%.
Yeah.
Just wondering if maybe
no move here.
Maybe I'll just sell premium on both sides.
No move here. So last 4, I mean, again, I don't know the exact implied move, but just looking at the overnight, I mean, obviously end of day, this was a big one. Overnight here, maybe the last one, they barely hit the implied move and then faded it from there.
Yeah.
So what are you looking at here, Nate?
Well, I might just sell premium on both sides and see if it's a nothing burger again. I wish the implied move was a little bit bigger. I wish it was, $16. I'd like it more, but I don't know. It's almost like, what does Kane think? It's almost like the market has not proved that it wants to do anything in weeks and weeks and weeks. Now we had that one burst that Jackson Hole gave us, and it just is dead set on going nowhere.
Yeah, it just the market's waiting for something to get excited about, right? So the big thing about Jackson Hole was, are we going to get rate cut? Are we going to get 2 or 3 rate cuts by the end of the year? It seems like we got our answer, is that yes, we could positively expect that we'll get those 3 rate cuts. And after that, it's like, oh, what do we get really excited for? NVIDIA earnings, maybe that's big enough, but there's not a whole lot more. We also happen to have GDP announced tomorrow, so if there's a big surprise there, that could swing the market. But we've also had an amazing run up since April. So a pause at some point, at the very least, if not a little bit of a pullback or a correction, is appropriate before we see another leg higher.
Yeah. I mean, I guess people have said like, oh, like NVIDIA might be the spark the market needs. And it's not like I'll be shocked if it is, right? Because I totally agree. The market wants a spark. It's kind of sitting back. And NVIDIA, I think, is still the most important stock in the market right now. But like, it hasn't been that spark, I think, as we just looked at the last 4 or 5 times. It's kind of like the expectations are so high, it'll beat. People think that's good, not good enough to lift it 10% and get the whole market going, just good enough to say, yeah, NVIDIA is still great. And we end up right back kind of where we are right now, or at least, in relative terms, quite close to that.
Yeah, and what we've seen the last couple of days is that I don't know if you guys look at RSP versus SPY, but RSP has really come up. And so what we're seeing is a lot more breadth. So we are paying more attention to a wider range of stocks other than just the Mag 7s. So the Mag 7s by themselves, of course, they'll always help. Their market cap is huge. But if we have if you don't have that large number of stocks participating as well, it's going to be harder to move the needle at this point in time.
Yeah. And interesting on that note is the S&P's at all-time highs today. I believe, correct me if I'm wrong, but I believe we're at all-time highs today. QQQ has not made that move. So your large tech is actually slumping off a bit on momentum. Meanwhile, so we talk about divergence in here. Kane, obviously, you and Roger talk about that quite often as well. We've seen stocks going higher, but the momentum readings on my Newton here is slowing. So we're seeing a divergence in the QQQ, but you just mentioned RSP. Let's look at RSP. RSP is moving higher, right? There is some divergence here, but if you were to draw a line right here, it actually is not trending down. It's technically kind of broken out of that downwards divergence here on our RSP. So it is a very interesting note there.
Well, and the other thing, to Kane's point, to what we talked about, I think that was Friday, where we said, hey, in a really bullish market, we expect, kind of risk on to risk off to be trending at different levels. And you'd see, Bitcoin at the top of the list, then the Qs, then the SPY. And we've seen an exact flip of that in the last couple of weeks, even though we are at all-time high. So there definitely is a changing of the guard. Now, is that a real rotation? Yeah, Kane, I said, for me, I'm always more nervous when that flips than just like the market dumping 2% and everything being like a liquidity flush. I'm always more nervous on the flip than just the straight up drop. And so, we're still in the middle of that. And maybe that also tells us that NVIDIA could have a harder time being the spark that really gets everything moving in the right direction.
Yeah, if you take a careful look at which sectors led in the past 2 or 3 months, what you'll find is that home builders and construction has been at the top. Mm-hmm. And then also what's the other one? I'm blanking on the other one. Sorry, guys. Shipping has been doing okay. And then we also have solar and clean energy or alternative energy like uranium or nuclear type of plays. Those are the ones that are getting a lot of attention. And that's not tech. That is That is a little bit more fundamental. It's more infrastructure. And a lot of that has to do with the expectation of lowering interest rates. So normally lowering interest rates would help tech as well. But since we're not seeing that stimulus and we are seeing it in other areas that are interest rate sensitives, that I would be very careful.
Yeah. All right. So I'm just going to look. Graham, did you check how much premium you could get kind of boxing it near the?
It's really good. I mean, it's 60% return on investment.
I'm going to do that. That's
my
guys. And when I say I'm going to do that, I don't mean, hey, I just came up with a really high conviction play that I'm super excited about. I mean, just to do something today with.
Well, let's ask the chat here. Who is there's 3 options here. So wait for the options to come out before you start posting. Who is bullish on NVIDIA? And bullish would mean you think they're going to hit or beat their expected move of $11. Again, that's about 6-7% on the stock. Who is bearish? Who thinks they're going to miss and then drop $11 or more? And then who is neutral, thinking it's going to be somewhere in between? Those are your 3 options. All bullish and neutral so far.
Yeah.
No bears. Hey, no NVIDIA bears.
Oh, I think I saw
there's one. There's one.
Saw one.
Oh, yeah.
Two.
Here we go. We got another bear.
All right. We've got maybe 3 bears and a lot of bulls.
So why don't we do this? Why don't we give out a trade for the neutral folks and then also a trade idea for the bullish folks?
Okay. Yeah, I'm going to take that neutral one. Did you go all the way to the market maker move on that one? I didn't get a close look at it.
So here with NVIDIA, what I did was use the 29th of August expiration. And let me just collapse this, make it a little bit bigger for you guys. 29th of August, that's this Friday. So obviously we're still going to have Thursday's price action and Fridays. But using that $11 market maker move, we would be doing boxing in here with an iron condor, technically speaking, which sounds a little scary, but it's just 2 spreads paired together. So we're doing that with the 170, 165 strike, and we'll type this all out, which would mean it could fall, but it's just not going to fall more than the market maker expected move. On the other hand, on the top side, we're looking at 192.5 and 195 strikes here, which would, again, say it could jump, but it's not going to jump more than $11 by end of week.
And one thing I want to mention, I think this is important. Actually, this is what me and the HQ members are going to talk about more in depth on Friday, is that when I look at a trade like this, even a trade that's not like a high conviction, I'm going to put a lot of money into. It's just a trade that I'm going to throw in my active trading portfolio. I don't look at every trade as a one-off individual trade. I'm actually also thinking about where the rest of my trades are. And so in this situation, I think I mentioned this also last week on a different trade, I'm still mostly bullish because the market's very bullish, and income machine trades and all those are bullish. My automated options are bullish. My overnight options are bullish. So I'm really, really bullish. And so the idea here for me then is if NVIDIA crushes earnings, is up 20% tomorrow and drives the whole market up, and I lose my neutral trade, I'm pretty okay with that because it probably means it has the rest of my portfolio moving in the right direction at a big net advantage. So I'm someone who, when I kind of look at all my trades, I actually do sometimes shift a bit. Not, I'm not going to make completely different trading decisions, but I shift a bit just simply based on what the rest of my portfolio is and the fact that, like, hey, what does a loss actually mean here? And if a loss to the upside means really good things for the rest of my portfolio, I include that kind of in my overall approach.
Yeah. And just for note, I'm typing this up right now. Forgive me. It's a little bit longer than we, more legs here than we typically do. This is a credit that we were doing here. So it's a net credit that is just 2 credit spreads together. So make sure you're seeing credit. But the reason why I'm doing a credit here and not a debit is because both strikes are going to be out of the money. So ideally, the way this would work is it stays, NVIDIA stays in between those 2 lines and it expires worthless. Versus if you did a net debit and they both would be in the money, you would have double exercise fees. Or if you were to close it out early, you'd be paying commissions on the other side. So since we're so far out of the money here, I'm going to look for a credit versus a debit. Hopefully that made sense.
Yeah.
All right. Sorry, I'm still typing this up. 170 put, and then I'll post it in the chat and then I'll show you the numbers behind it. Here it comes. There are 2 break evens on an iron condor. So the cool thing here, and someone let me know if I made any errors. Oh, shoot. Don't look at that. They all say buy. Can you delete that?
Made some errors.
Yeah. Dave, can you oh, thank you. All right. Good thing I double checked. All right, here we go. Now it should be good. So buy 195, sell 192.5, buy 167. Okay, perfect. So the way this works is, how do you define risk here? Well, the risk that we normally define on a spread is the, in this case, because it's a credit, the premium we're receiving up front deducted from the width of the spread. So 250, let's just call it $1 for example's sake. So say we get $1 up front and it's 250 width. That would leave us $1.50 of risk, 67% return on investment here, if we're right.
Graham, don't you know you're not supposed to tell people the risk when you're doing income play? You're supposed to just pretend like it's magical income that hits your account no matter what. What do you?
Yeah, my
rule
bad.
Number one.
He's joking. He is joking. But you might be looking at this and saying, wait a second, that makes sense. That's how we normally do it. But we have two different spreads here. So shouldn't our risk be $2.50 here and $2.50 here, making it $5? Well, theoretically, you are thinking along the right track. However, here's the question. Can NVIDIA finish both below 167.5 and at the same time finish above 195 by the end of the week? In other words, can NVIDIA simultaneously be up here and down here by Friday? The answer is no. So we don't have to add the two strikes of risk together. Because this is an iron condor play, it can only hit us one side or the other. So that's why that's how we define the risk there. Hopefully that made sense. And again, we don't do a lot of training here in the old closing playbook because we try and get some trades out. Now let's do a bullish one. In my opinion, the easiest way to do a bullish trade would just be an at the money, or what I call a wrap order debit spread, where you're wrapping the current price with the two closest strikes. As you can see right here, right now, they're 250 strikes, $1.25 to enter. That's a double on your investment if NVIDIA finishes $1 higher or more by the end of the week. So you can do that. However, when it comes to earnings play, I would look to go a strike or two out of the money. Maybe not the full implied market maker move, which you can do, be my guest, but let's look one strike out of the money. It's much cheaper to enter, which then makes our profit potential much higher, which the reason I would look for that here is, number one, it's more likely than not going to make a move of some sort. It may not make the full $11 move, but it'd be very reasonable to make a $5 move, which would clear our strikes here. Secondarily, think of earnings more like a coin flip. These are not our normal analysis where we go through and do a deep dive and check the strength, the sector, the seasonality, all that. No, these are more of a coin flip. So if you're going to flip a coin, would you rather do that, risk $1 to make $1, or $1 made, $1 lost, or would you rather do it, flip a coin where you make $2 and lose $1? So in other words, we want our risk to reward to be above 100% because we do have about a 50-50 chance, generally speaking, of being correct. And again, I apologize. I wish we could break this down further in here, but that's something we'd have to do on the opening playbook. So I'm going to type this one up. Bullish NVIDIA earnings play. NVIDIA, and this one is a debit spread. So look for a net debit here. 29th of August, 25th expiration, 182.5 call is what we're buying. Selling 29th of August, 185 call, net debit. And you can even go further out if you want to. Just keep sliding those strikes if you want to. Here we go. There's your bullish trade right here. So here our risk to reward is we're entering for $1.10. Oh, excuse me. I was thinking credit spread in that. I was typing that up. All right. Entering for $1.10. So 140 is our max profit. So here, if NVIDIA pops $4 or more, again, that's 1/3 of the implied move, roughly speaking, you make 127%. If you slide even further out, if you go to the 185 call, 187.5 call, you're going to be looking at a bit more. You're going to be looking at 163% return on investment. So that's another way to play this. I'm going to just leave my iron condor on and see what happens from there. All right. I did a lot of talking. We got 4 minutes left, 5 minutes left till the close. Anything else? Any other pointers that you guys had on for today?
Sorry, I got some beeping going on in my background. But yeah, let's wait for the market to close before I really go into this. But there's a couple other ways that we could play this using that could take advantage of both the neutral and the bullish sentiments that we've been talking about so far.
Okay, cool.
Yeah, I don't want to distract people before the last few minutes while they're trying to put in trades.
Yeah, I'm trying to get filled still on my side over here. So,
and then for the most part, did my explanations make sense? Or
yeah, I think so.
Pretty quick.
So. Yeah. You know, folks, if this is, you know, new to you and it's a little too fast for you to really follow and kind of confidently put the trades in, you don't have to take the trades. You know, everybody's at a different point in their trading journey, and we serve a lot of people in Closing Playbook, and we try and get trades out. But if they're, you know, just kind of over your head and you're not sure, don't go placing trades that you don't really understand, or you're not sure you're entering into your trading account correctly. There's time to learn and time to take these types of trades later on in your journey.
Awesome. Did you guys see anything fun from any of the other earnings names? I didn't even get a chance to look. Again, it's been a busy 48 hours. Hopefully you guys are pretty excited on kind of what I quickly showed you.
Did you see, did you talk about Ulta by chance? Is Ulta tomorrow? Or is that, let me see.
Ulta is after the market closes tomorrow. So we can do that tomorrow.
Okay. All right. That popped up on one of the scans I had, so I didn't know if you talked about that, but interesting. $530 stock, but a pretty big implied move there on that one.
Yeah. Joshua, don't believe you'll get filled on the Iron Condor. I put mine at 99 cents, and then I just had to adjust it to 97 cents, and it filled there. Again, with a debit, you want to pay the least amount. This is a credit, so ideally we want the biggest number there. However, to get filled, I revised it down to 97. All right.
Hankford has a point also. Just, you know, even if you take the trade, but you can't get it in fast enough and you miss the price, don't go chasing it. Take it at the right price or don't take it.
And my rule of thumb, people ask this question all the time. My rule of thumb is typically like around 5% of the value of the trade. So if you're trading a $5 spread and it's $2, that's gonna be a little bit different than if you're trading a $1 spread and it's, you know, 60 cents. You know, and also obviously if you're trading with Jack Carter and maybe you're only going for a 6 or 7% income trade, well, then you're probably not going to want to chase by 5% in that situation. So obviously, you know, use wisdom. It's all relative, but typically if you're doing like a wrap order, like you know, Graham does, or something more aggressive, I just use that 5% rule of numbers so that I have in my own mind a mental stop as I crawl the price by a penny or two. I don't just get that mindset of, okay, one more penny, because with a spread, as I've shown you guys in Opening Playbook, you crawl it up a couple of times, you don't realize you just turned a 100% ROI trade into a 68% ROI trade, you know, crawling it up 7 pennies, because it kind of jumps on you quick when it's being eaten from both sides when it comes to a spread.
Yeah, if you want to, I mean, we've only got a minute. Again, these are not high conviction trades, so I wouldn't go rushing in. But Snowflake is expected to be a big mover, $21. So you could apply something similar there, or you could do a two-way option like Nate normally does. Like, so you see here, moved huge on earnings. So what you can do is you can do a spread in this direction and a bullish spread and a bearish spread in this direction. And if it closes in either direction, you make 30, 40%. Right now in Snowflake, if you do half the market maker move, again, we're not going to have time to walk through all of this, but this is something we can consider in the future as well. Half the market maker move, you're looking at almost 30% return on investment. The NVIDIA target for the bullish spread there, so you could close it tomorrow. It's not going to see full value tomorrow, but Friday at end of day would see full value. I would be looking, personally, again, I like to go for about 100% or more on earnings trades. But if you like it tomorrow in the morning, you can take profits, because there is a chance of fading. I mean, this was, I'm not zoomed back far enough, but let me show you this. Like, this is a very... This can happen. So here was earnings back in February, popped overnight, faded all day. So if you want to take profits in the morning, that's just, you know, the safest way to play it, if you will. NVIDIA, yeah, they're after the bell today.
By the way, one more. I know Kane's going to jump in a little bit deeper, but one more thing to mention about the iron condor versus the reverse iron condor, if you will, basically putting it in a box versus making it break out the box. If you're making it break out of the box and you need it to beat that expected move, and it does, and you want to take profits early, typically you will not get as much of the value of that trade offered to you, on a Thursday, because it made that big move, and it's more likely going to come back into that box than stay out of that box, or at least relative. Versus if it misses earnings and now you have like a much smaller move, the market's not going to price in. Now it's going to make that $18 earnings move with no earnings catalyst over the next couple of days. So you can usually get a much bigger chunk of your profit out of the traditional iron condor than the reverse iron condor. So those, in my opinion, I think are even easier. Just throw in a target for $2.47, and if it fills you because of that expected move going down, just get out of that trade and recycle those dollars quicker. It's a little bit easier in that than the opposite. That's a quick explanation. We can go in deeper if that's over some people's heads, because that's a lot of different factors to take in.
Yeah, and then I've got 2 more points, and then Kane, I'm going to turn it over to you to talk us through how you typically trade. First thing is, NVIDIA earnings don't report. I think someone said 4:20. The stock's going to move like crazy through 6 o'clock for probably all night, honestly. I honestly, at this point in time, if you just watch the chart, you're just going to have your blood boiling, your blood pressure increasing. Things are going to be going crazy. I would just recommend at this point, just close out of your brokerage. In fact, I think that's just a good thing to do. When you have a play on, you can't do anything about it till morning anyways. So there's no reason to stress about it all night. Now is a good time to be just exiting out of your brokerage and focusing on something valuable and productive that you can do for the remainder of your time. And secondarily, so that's my first point. Just don't look at the charts right now. Let's look at it in the morning. Second tip is, this is not normally how we trade that complex. Sometimes we do, but typically it's much more basic. And I guess my question I have for you guys is, do you guys like it when we do this more in-depth, complex or more complex stuff, or do you prefer the basic stuff? Just curious for your take on the chat. What Kane's going to show you next is a very, very basic trade, very similar to how we trade. Nate trades his jump trades. I trade my wrap orders or overnight options, but there is a slight adjustment, and it's very, very important. That makes it different than what we do and advantageous for certain scenarios. So, of course, this one today was more complex. Kane is going to walk you through a much more basic type of trade that's quite in line with what we do on the day-to-day normal trading basis, with a little different advantage to it. So it's going to be totally new for you guys, but it's going to be the same sort of process for trading a basic spread versus an iron condor or something like that. I know, Kane, you might do something like that every now and then, but generally speaking, basic. So if you don't mind, why don't you go ahead and if you can quickly, or whatever, take your time, take all the time you need. You can stay here till 9 o'clock if you want. But why don't you walk us through the way you trade options, and so you guys can kind of see the benefits to it.
Yeah, let me make sure I'm sharing my screen. Is that correct?
Yeah.
Or you probably
bring it up in a second.
So,
you almost put us in the vortex.
Yeah, I was thinking I probably should move something out of the way. Okay. So there's a couple things that I want to go over, and this will lead into what I'm going to talk about a little bit later. And that was the other way that we could trade these NVIDIA earnings. So one important concept that is true for any time that you're trading, but especially true if you're going to trade a spread or even a single option, is if I completely lost you guys. I don't even know. I'm basically just talking at my screen right now. So if you see something weird, then just let me know. All right. So basically, it's very simple. And I'm going to say it, and you're going to say that's retarded, Kane. But then I'm going to teach you how. Okay. So basically, you want to buy cheap options, and you want to sell expensive options. You're like, okay, Kane, that's retarded. Of course, you want to buy something cheap and you want to sell something expensive. The question is, how do you do that? And a lot of people will tell you, look at the implied volatility. You want to sell when implied volatility is high. You want to buy when implied volatility is low. And if you try to do that, most of the time, I don't know if any of you have tried to do that, but please let me know if you've successfully been able to consistently profitably trade by selling high IV and buying low IV. Like say, hey, IV is really high, let's do a credit spread. Or IV is really low, let's do a debit spread. Have you guys heard that before? I'm getting not so much. Okay, so Dark Bane is telling me not so much. And I don't know, MME is saying no. Sweet Chin is saying no. I've heard those things. Joshua is saying no. Yeah, it sounds like good stuff, but in practice, it doesn't really work out for you. And the reason why, the number one thing that people don't realize, let me just go over here, and we'll take a look at an NVIDIA spread over here. So I'm going to build, actually, NVIDIA might be skewed, but let's try it anyways. So if I do a bull call spread on NVIDIA, and then I do a bear put spread, or sorry, a bull put spread. So I have a bull call spread and a bull put spread. One is for debit and one is for credit. And I'm going to do the exact same expiration. So that is August 29th. And I'm going to do the exact same strikes. So let's try 185, 180. Okay. Okay, so what we see here is that if I pull this out, it's going to be easier to see if I pull it all the way to expiration, and then I'll talk about in between cases. So what we should see is that as long as we don't have weird market skew, then the max loss and the max gain should be basically the exact same. So over here on this bull put spread, which is for credit, I can collect a credit of 265. That's my max profit. And then therefore, since this is 5 apart, I can lose a maximum of 235. Now let's look over here for the debit spread. Basically the same thing. It's just $2.50 apart. Right? So here I pay a debit of $237.50. So that's my max loss. And then my max profit is the $5 minus the debit that I paid. So if I just adjust this price a little bit, let's see, what do we do here? Just to make them the same, just so we can make it a little bit easier to compare. So there's, come on, $2, 4.41. Oops, wrong direction.
3637.
What am I doing? I need to sell it for less. 4.3. What am I doing wrong, guys?
No, I think you just need to go a little lower, right? Like you want it to go 7 down from 31, would have been like 234.
Yeah. Okay, here we go. Getting closer.
Right? Yeah, something like that.
There we go. All right. So if I do this, and let me just lock in these prices. Okay. So what we see is that our max gain begins at 185, and I can make 265. Over here, my max gain begins at 185, and I can make 265. Over here, my max loss begins at 180 and below, and I can lose 235. And over here, same thing, begins at 180, and I can lose 235. These two spreads, mathematically, synthetically, they're the exact same. And I don't care where we are. So if I say, okay, on Thursday, August 28th at 11:03 a.m., that is Pacific time because I'm West Coast. Okay. And I say, okay, well, what if we are at $188? Well, this one tells me that I am 180. Where is that? Let's do dollar profit. Okay. Because percentages will be deceptive. Simply because when you do a credit spread, suddenly they do the calculation based on your credit, not based on your max loss anymore. So that's what makes it deceptive. So you're not comparing apples to apples when you're looking at the calculated percent gain or loss that the software gives to you. So at $188 over here, it's looking like that I could be in $106, or just call that 106.53. Okay. Now about here. And it's hard to get it exact, but basically it says 108. Okay. But within a couple dollars, I'm making the exact same thing. In actuality, you'll find that if I could get everything exact and precise, they would be the exact same number. These are the exact same spread. A lot of people don't understand that. The math is the math is the math. You cannot dispute it. These are the exact same spread. It's just that you're one person expressing it with calls and one person is expressing it with puts. Okay. And one is collecting a credit and one is paying a debit. But it doesn't matter if you're collecting a credit, because yeah, maybe that cash hits your cash balance, but guess what? It's getting taken out of your buying power. So when I put on this credit spread or this debit spread, I am getting $260 or $235 removed from my buying power, removed from my margin. And over here, what am I getting removed from my margin? Same thing, the same 235. So there's absolutely no advantage on picking one over the other in this context. What the advantage comes is purely management and psychological. Mathematically, there's no difference. Okay, and I don't want to get too far down the rabbit hole, so I'll just leave it at that. Just know that they're the exact same. So if you told me, Kane, high IV, you're going to do a credit spread. I'm going to tell you why, if I can make the exact same debit spread with the exact same mathematics. So it doesn't make sense, right? It doesn't make sense. Say, oh, high IV, I'm going to sell a credit spread, and low IV, I'm going to buy a debit spread. Mathematically, you're doing the exact same thing. There is zero advantage for you to do the credit or the debit spread if that's how you're looking at it. So there is advantage in being able to structure your spread appropriately to capture the idea that you want, but simply saying, hey, I'm going to do a credit spread because it's high IV or a debit spread because it's low IV, it's not going to help you. Okay. And also, if I say, oh, it's high IV, I better sell. Okay. So if I'm bullish on NVIDIA and it's high IV, I better sell puts instead of buy a call. Same difference. The same thing as this. It doesn't actually give you an advantage to sell that versus the buy. What it happens is when you sell that put, then basically you're capping your gain, but not your loss. But when I buy that call, I'm capping my loss, but not my gain. So I'd rather buy that call in that instance. So if the IV is high, it's because the market maker expects this stock to move. And so it actually sounds kind of backwards. Maybe I want high IV stuff because most of the time the market maker is right. They're pretty good at their job. And so if they're pricing something very high because it might move a lot, then it might be a good idea to buy that option because the underlying can move a lot. Right. And if you say, hey, IV is low because the market maker expects it to go nowhere, and then I go and I buy that call or I buy that put, and then the underlying just goes nowhere, I'm just getting destroyed by time value, by time to gain. And so it doesn't make sense to pick my option based on IV or to define something as cheap or expensive based on IV. So what does make sense? How do I figure out if an option is cheap or expensive? So the way that I like to do it, my favorite measure, is to take my extrinsic value and divide it by the number of days left to expiration. Okay. So if I buy this at the money, I'm paying $5.20 or 50 something cents, 52.5, just call it 5.55. I'm paying $5.55 for this. Okay. And it's all extrinsic value. Why? Because it's not in the money yet. So that means I have 2 days for this thing to work out for me. And if it goes nowhere, then I spent $5.50 or $2.75 per day of time. So that time, basically each day cost me $2.75. what if I go out to September and I do the exact same strike? Still all pure extrinsic value. And now it's $8.10. And you're like, Kane, this is the more expensive option. Obviously, it's $8.10 instead of $5.55. But how much is it costing me per day? It is $8.10 for 23 days. That's only like 30 cents per day. Okay, so let's say $8.10 divided by 23. That's 35 cents per day it's costing me. So what that means is, in the next 2 days, if the market goes nowhere, this option is going to lose me $5.55, but this option is only going to lose me roughly 70 cents. Therefore, this option is way, 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 way cheaper. Okay, so and then there are more sophisticated ways to calculate that decay per day. Of course, you could use the exact pricing model, but that's a giant pain in the butt. But there are a little bit more sophisticated, but still relatively easy ways to estimate that. But I just want to show you that demonstration. Okay, so what did we start out saying? I want to buy the cheap option and I want to sell the expensive one. So what does that mean in this context? Right. So if I measure everything, if I determine if it's expensive or cheap based on the time decay per day, then, or the extrinsic value per day, then this one was really expensive. It was $2.75. This one was only 35 cents. So what could I do? I could sell the 29th of August 182.5 strike call and buy the 19th of September 182.5 strike call. That would be buying a cheap one and selling an expensive one. Or let's do it a little bit closer. Let's, instead of going all the way to September 19th, let's just do 1 week out. Let's do the 5th of September. Okay, over here, how much would this one be? This one is $6.42 with 9 days left. That's still only about 65 cents. Okay, so if I do $6 and I'll just call it 45 cents divided by 9 days left, 71 cents, 72 cents. That is way cheaper than 285. So why is that? Why is there such a huge difference? Well, one, because time decay operates a lot faster when we get towards expiration. But number two, because this option is expensive. Why is it expensive? It is expensive because we have earnings coming up and the market maker jacked up all the prices. Now, we could say that that's also reflected in the implied volatility here. Implied volatility over here is 114%, and it's only 63% for the September 5th. Okay, so yes, it is also being reflected in IV. And so what other people say is true. IV high, relatively high, then expensive. Yes, that is true. However, it didn't help us trade, right? All of us said we were never really consistently or profitably able to trade based on IV. So it doesn't help us to know that the IV is telling us that it's expensive. This way, it is helping us both know that it's expensive and to know how we're going to trade it. So over here, this is the more expensive. And so what if I do this, if I sell this one, this more expensive one, and I buy this cheaper one, then what will happen is I've done a calendar spread, right? I'm selling a near dated expiration and then buying the exact same strike, but a far dated expiration. And that puts me into a calendar spread. So this is the distinct advantage of a calendar spread. This is how you make calendar spreads that make a lot of money. It's by buying cheap, recognizing that you're buying cheap and selling expensive. So what if I did 1 week apart right here? Okay, so let's take a look at this. This is $6.15 divided by 16 days. Okay, that's 38 cents, 38 and a half cents per day. And then over here, I do the September 19th, and I look at that, and I think we already said it was like 35 cents per day, right?
Yeah.
If I remember correctly. Yeah. So that's only 3 cents apart. So it doesn't. Sorry?
No, go ahead. I was saying not a big difference.
Right. Yeah. Not a big difference at all per day on a per day basis. So so the earnings gives me this unique opportunity, not really unique opportunity, but this oversized opportunity of finding something that is really expensive and being able to buy something that is at least normal priced or cheaply priced. And so this is a great way of doing another earnings play. And if I model this up, I'll try to speak faster so we're not here forever. But this is why
people want to hear it at a pace they can ingest it. So you're good. You're good.
Okay. All right. So if we go and we do this calendar call spread on NVIDIA, and why is it showing me so many dates? Let me do this again. Okay. Okay. So here, if I do NVIDIA, are you guys following so far? Is this making sense? Are you learning something new? New insights, new aha moments? Okay. So if I did these two expirations, the ones that we just did, that 182 and a half. Okay. So what we see is, now take a look at this. But first take a look at this with a grain of salt. Just by doing this calendar spread, look at my break-even points. That's at 167 and almost 203. And if we look at the Iron Condor that Nate showed us, well, what were those break-evens? If I remember correctly, it was like 175, 190, or was it 170, 195?
It was I think it was 171, 196 or 195. Yeah.
Okay. Yeah. So 171. So that's well inside this break even. Okay. So already I've found a spread that has a wider range. And how much were you getting paid in that? I think he said about 60%.
Yeah.
60%. Look at this max profit versus this max loss. $516 versus $90 max loss. Okay. So that is 600% potentially. Okay. Obviously, you would have to stick it right in the middle, but there's that potential. So the reward risk here is a lot better. Now, I said take that with a grain of salt because we are also going to get a volatility crush after tomorrow. And right here, we have implied volatility being priced at 85%. Okay. And that is somewhere in between right here. So what if it crushes tomorrow after NVIDIA earnings? What if it does crush down to 65 or 60%? So we do need to adjust this for that volatility crush. So let's go down to about, what was this at? So just go about 20. Okay, 20. Okay, so does that change our story a little bit? Look at my break-evens. It's still right on top of, or maybe slightly better than that Iron Condor that Nate showed us. And I still have a max loss of 90 and a max profit of 373. So that's a 400% possibility. Okay. So this calendar spread, if we stay within range, it should make us some nice bit of money. Now, there's a couple of possibilities. What if it goes down? Okay. If it stays here, or
hey, Kane, can I just ask you, can you zoom in on that browser at all? Is that something you can do?
Just like that?
Yeah, perfect.
Okay.
Yeah.
So if I need to find you instead, so I can see you instead of having it.
It should be up at the top. Oh, if you look in the other screen where the chat is, you can see.
Okay, I see it. Okay,
I
see it.
Okay. Yeah.
Okay. So if we take a look at this and we say, okay, tomorrow we end up over here. Okay. or we miss earnings. Let's just say we miss earnings, and we're down here, and it looks like we're taking a loss. So if I sell a call, okay, and the underlying price goes down, do I make money on that call or do I lose money on the call that I sold?
You got to give people in the chat a couple extra seconds because there's like a little delay from what we're doing on one platform till it gets over to them.
People are saying lose. Okay. Let's think of it this way. If I bought a call and the price went down, would I make or lose money? If I buy a call, if I own a call, then I would lose money, right? So therefore, if I sell a call, it should be the opposite. If I sell a call and the price goes down, then I should make money. Okay. So if we go down here, then I made money on the short-term expiration, but I've lost money on the long-term expiration. And so I should have made more on the short term than I lost on the long term. Does that make sense? What if it goes, well, let's not make too many scenarios. So let's just say that's it. Okay. Or what if we move so far beyond my break even tomorrow? And you go, Kane, it looks like I lost 40% over here. Okay. I lost 40%, which means I lost $45. Right? And that doesn't mean I lost a whole bunch of money. It means I lost $45. So if I lose $45 over here, then fine. That's fine. I made money on the one that I sold, so I buy it back. I'll buy it back for next to nothing. Right? I sold it for $5.50. I'll buy it back for almost nothing. But I lost money on my long call. But guess what? If it's an overreaction, what tends to happen? It tends to bounce. So I will just keep my long call and wait for that bounce. And then net, I'll probably still end up making money. Even if I end up closing this at break even, I'll have made money on my short. Okay, so this is a little bit more forgiving because I have extra time for the market to go up. And if I believe that the market is going to go up, let's say we gap up and I think we're going to run, then again, I can buy this back. It'll look like I'm losing a little bit of money on that because I'll sold it for $5.50 and then bought it for say $7.50. But then as long as this keeps running up, then I'll keep on making more and more money on it. But if that's too complicated for you, just treat it as a spread because it is a spread. And that means as long as tomorrow, after the implied volatility, after the IV crush, still, as long as we end up in between 171 and 196, I would still make at least some profit, right? Which is really good. And my reward risk ratio is really, really, really high. And again, the reason for this is simply because I sold something expensive, really expensive, and I know exactly how to measure how expensive it is versus something that was cheap or normally priced out here 1 week away. Okay, so that's how we take advantage of that. That's called a calendar spread, and that's exactly the premise of my morning payout program. So I do this on an overnight basis. I do this in the SPY. And overnight, what we're looking for is I'm looking to find an expensive option over here, somewhere over here. And then I'm looking to find a cheap option somewhere over roughly 1 week away. And if I can find that, on most days I can, then I can model it up just like I showed you guys over here. And I can look at that break-even point and say that break-even range. Whoops, did I get rid of it somehow? That's unfortunate. Or maybe it's just, oh no, it's over here. Okay. So
too many windows.
Yeah. So if I can do that, then and I have a nice wide break-even range, then as long as the market doesn't move outside of that range the next day, or then I can capture some really, really consistent and lucrative results. Now, I'm not chasing after huge wins over here. It's only an overnight trade. So in my program, I've designed everything so that we have small drawdowns. So when we lose, we don't get completely destroyed. And when we win, we win very consistently. So it goes on long win streaks, and then it has very short drawdowns. When we lose, we don't lose that big. We make up for that loss within 2 trades, usually on average, 2 trades. And 2 trades for us means 2 days. So you recover very, very quickly. And then and that together, so the small drawdowns and the quick recovery plus the long win streaks means that it is really, really efficient at compounding. And you'll see an example in the presentation that we're going to show you where $1,000 was compounded over the span of 2 years. And I'm not going to give it away, but you'll be surprised by starting at $1,000 and having a really efficient compounding system, how much money that can really turn into. So with that, I think any questions, anything I can answer before we get into that?
Before we jump into that presentation, I do have a couple questions from the crowd. So one is you went from like the initial one, I think we were looking at a couple of days compared to like a couple of weeks, but in the program you're looking at overnight compared to 1 week, correct?
Correct. So the one that I did actually is very similar to the one that I showed everyone, because the NVIDIA is 2 days out and then a week after that. So, but in the program I'm about to show you, it is 1 day out and then about a week after that. So it's very similar to what I showed you guys.
Can you post I don't know if you still have it, but can you post like the sample one you just went over just so people could see what the actual trade looked like
Sure.
in the chat? Can you put that in the chat?
I'll type that out. Yeah.
Okay. So again, Kane's going to post it in the chat. This is not a do it now trade recommendation. This is just the example from the education that we just went through, as to how, it winds up looking as a 2-leg trade, a 2-leg spread. When you're looking at profit targets, what kind of percentage is your minimum percentage that you look to get out of it when you're putting the trades together? Like, what's your minimum ROI that you go for?
Well, so it just depends on the probability. So if I have an edge, if I know that I win 70-80% of the time, then I'll be happy with 1-to-1 reward risk ratio, or even slightly worse than that, because I know I win so much that I'm just going to collect over time a lot of profits. But something like this, so something I showed you guys on NVIDIA, it's, who knows, right? It's a 50-50 shot. So if it's a 50-50 shot, I want better than a 1-to-1 reward risk ratio, which is what I showed you on this NVIDIA one. Even if we accounted for a volatility crush, that was a 4-to-1 reward risk ratio. It was really good. So in this case, if I was building, I would not accept anything worse than a 2-to-1 reward risk ratio.
And is there like a minimum width on it that you would do? Like, you're never going to do it unless there's a range that's a certain size, or is it really from pick to pick different?
It's different. So in the NVIDIA trade, we had the market maker tell us what that range was going to be, right? So and then we compared it to basically that's what Nate used to build his spread, and then we saw that my break-even range was even bigger than that. Right. So I'm okay with it because I'm bigger than that market maker's range. And on a day-to-day basis for the program that you're about to see, then basically I'm looking at VIX and volatility to help me determine what the next day's range might be.
Gotcha. All right. Well, let's, I know a lot of the other questions that were asked are going to get answered by this presentation. So why don't we go ahead and jump into that? Thanks a lot, Kane, for being here, for spending so much time going through that. That was an amazing, detailed explanation of, calendar spreads, which is not something that Nathan and Graham usually get involved in. So this is, kind of new material for people that are just in their programs and not in yours. So really appreciate it.
Yeah, absolutely. Hopefully people learned a lot, and I hope you guys are excited to see what I'm about to show you.
Yeah, absolutely. All right. This is going to be a replay of a recent session that you did where Roger hosted you. We know Roger.
That's right.
We love Roger.
Mm-hmm.
All right. Thanks, Kane.
Yep.
Folks, the profits performance are not typical. We're not going to make any future earnings claims, and you may lose money. The trades expressed are from historic back-tested data in order to demonstrate the potential